Have you ever looked at options trading and just thought it was essentially gambling with infinite risk?
Oh, yeah. I mean, that is probably the most pervasive myth in all of finance.
Right. Because you hear these wild stories online, people blowing up their entire life savings overnight,
Right.
literally losing more money than they actually put into their accounts in the first place.
Exactly. It completely terrifies people.
It really does. It can feel like, I don't know, stepping into a casino where the house not only has the mathematical edge, but they can legally take your car and your house if the roulette wheel lands on the wrong color.
Yeah, that's a terrifying image. But the reality of how quantitative analysts and, institutional funds actually trade options is, well, it's so fundamentally different from that reckless gambling perception.
Which is exactly what we're getting into today. We're doing a deep dive into an exhaustive, highly technical research report on a structural strategy known as the credit spreads option strategy.
And it's a fascinating paper. It really pulls back the curtain.
It totally does.
Hmm.
So our mission today for you, the listener, is to decode how the pros actually use these specific structures to generate consistent yield with strictly capped risk.
Right. Risk management is everything here. It's about engineering risk, not just rolling the dice.
Exactly. And we are going to do it by stripping away all the intimidating jargon. Okay, let's unpack this. How do we even begin to construct a trade that caps our downside so completely?
So it all starts with understanding the basic architecture of what we call a vertical spread.
A vertical spread, okay.
Yeah. When most people think of options, they think of just buying a call or buying a put, or even worse, just selling one naked.
Which is where those horror stories usually come from.
Exactly. But a credit spread is a multi-leg trade. You are simultaneously selling one option and buying another option of the exact same class.
Wait, when you say same class, you just mean they have to be both puts or both calls, right?
Uh-huh.
You aren't mixing them up.
That's right. Both puts or both calls. And they also have to be on the exact same underlying asset, like the same stock or ETF, and they must expire on the exact same day.
Okay, so everything is identical except for one thing.
Right. The only difference between the two legs of the trade is the strike price.
And the key word in the name of this strategy is credit. So I'm assuming the entire goal of assembling this multi-leg structure is to collect a net credit up front. Like, I want cash deposited into my trading account the very moment I click execute.
Yes, exactly. And the mechanics of how you get that credit are really important to understand.
Walk me through it.
Well, you collect cash because the option you are selling is positioned closer to the current stock price than the option you are buying.
Right.
In the options world, an option that is closer to the money holds more premium. It's simply more expensive. So the cash you bring in from selling that short leg is always going to be mathematically larger than the cash you spend to buy the long protective leg.
I was actually trying to wrap my head around this concept earlier, and it really reminds me of the insurance business.
Oh, that's a great way to look at it.
Yeah, think about a retail trader selling a naked option, which, again, is what gets them into so much catastrophic trouble. That is essentially like writing an insurance policy for a coastal town, but with unlimited payout risk.
Right. You're just taking on all the risk yourself.
Exactly. If a massive hurricane hits, you are personally on the hook to rebuild the entire town. You're completely ruined.
It's a terrifying position to be in. I mean, the tail risk is theoretically infinite if the market moves violently against you.
But a credit spread, that feels like writing the policy, collecting that hefty premium from the town, but then turning around and immediately using a small piece of that premium to buy reinsurance for yourself.
Precisely. You're laying off the catastrophic risk.
Right. You're buying a policy from a bigger company that says, okay, if the hurricane hits, we cover everything above a certain dollar amount.
Mhm.
So if that catastrophic market crash happens, your losses are strictly capped by what is essentially a high deductible.
I really like that framing. It totally shifts the mindset from speculator to risk manager. And structurally, you can apply this insurance model in two distinct directions.
Depending on which way you think the market is going. Right?
Exactly. Depending on your bias for the market, you can use a bull-put spread, which is what you deploy when you want the stock to go up, or at least just stay flat.
And the other side of that?
Conversely, there's the bear call spread. You use that when you believe a stock is going to go down or if you think it's going to hit a strong ceiling of resistance and just stall out.
Let's make this incredibly concrete, because the math underlying this is really elegant, but it can get muddy for people without real numbers.
Yeah.
Let's walk through an example of a bull-put spread. Let's invent a hypothetical stock, we'll call it XYZ.
Perfect. Let's do it. So let's assume stock XYZ is currently trading at exactly $70 per share.
Okay, $70.
And you've done your analysis and you hold a moderately bullish assumption. You don't necessarily need it to shoot the moon. You just strongly believe the stock is going to stay above a certain floor over the next few weeks.
Right. I just need it to not crash.
Exactly. So you execute a bull put spread by selling the $68.50 strike put.
Okay, so I'm agreeing to buy the stock at $68.50 if it drops that low. And for taking on that obligation, the market pays me. Let's say I collect a premium of $2 per share.
Right. But we know we aren't stopping there.
No way.
Because selling that put alone leaves you with that hurricane risk we just talked about.
Exactly. I don't want to wake up in a cold sweat. So simultaneously, in the exact same order ticket, I buy the $65 strike put. That is my reinsurance, my safety net.
Right. And let's say that protective put costs you 50 cents.
Okay, so let's look at the net result here. I brought in $2, but I spent 50 cents to cap my risk.
So your net credit is $1.50 per share.
And since standard U.S. equity option contracts represent 100 shares, that is $150 deposited directly into my account the second the trade goes through.
Exactly. And that $150 is your absolute maximum theoretical profit.
Wow. Okay.
You keep every single penny of it. If stock XYZ simply closes anywhere above $68.50 at expiration, the stock could go to 80 or it could just sit at 71. It really doesn't matter.
Both options would just expire totally worthless, and I walk away with the premium.
You got it.
That sounds great when it works. But, I mean, what if my analysis is dead wrong? What if the CEO resigns unexpectedly, the broader market totally tanks, and XYZ drops like a stone to $62?
This is where the architecture of the spread saves you. If you had just sold that naked put at $68.50 and the stock dropped to $62, you would be losing $6.50 per share.
So that's $650 per contract.
Right, and the losses could keep piling up if it kept dropping. But with a credit spread, your risk is strictly defined by the width of your spread.
Let me make sure I'm doing the math right on that width. My short strike was $68.50. My long protective strike was $65. So the width between them is $3.50.
Exactly. $3.50 per share is the absolute maximum the trade can expand to. But remember, you already collected $1.50 in credit up front.
Ah, right. So I take the $3.50 width, subtract the $1.50 I already hold in cash. That leaves me with a maximum loss of exactly $2 per share, or $200 total per contract.
The bleeding completely stops at your $65 long strike. You risk $200 to make $150.
Okay, so I know exactly what my worst-case scenario is.
Exactly. And your break-even point, the exact price where you make zero but lose zero, is $67. Even if the company goes bankrupt and the stock goes to absolute zero, you cannot lose a single penny more than that $200.
That is the power of defined risk. It actually lets you sleep at night.
It really does.
But having a safe structure is only step one. Now we need to explore the unseen mathematical forces that actually dictate if this trade wins or loses as time moves forward. If you've ever looked at an options chain, you've probably seen these weird symbols at the top of the columns. The Greeks.
Yeah, the Greeks. They can be deeply intimidating because they are quite literally the differential equations that govern option pricing models.
Which sounds terrifying.
It does, but here's the secret. If you are going to trade credit spreads, you don't need a PhD in calculus. You just need to understand how they react to underlying price changes, to time, and to volatility.
Okay, so where do we start?
The foundational Greek you have to grasp first is delta.
My understanding of delta has always been that it measures how much an option's price changes for every $1 move in the underlying stock. So like a delta of 0.5 means the option moves 50 cents for every dollar the stock moves.
That's the textbook definition, yeah.
But quantitative traders use it a bit differently, don't they? They use it as a proxy for probability.
They do, and it's a vital shortcut. While mathematically delta is not a pure probability metric, standard market practice universally relies on it as an exceptionally robust heuristic for selecting your strikes.
So how does that apply to building our spread?
Well, the research outlines a major structural sweet spot for selling credit spreads. Quantitative funds systematically target short strikes at the 15 or 16 delta level.
And what does the 16 delta actually translate to in the real world for a trader?
It statistically translates to roughly an 85% probability of profit.
85%.
Yeah. It means the market is pricing in an 85% mathematical probability that the option will expire completely out of the money.
That is a wildly high win rate.
It is. It strikes the optimal balance. You get a high historical win rate, but you are still close enough to the money to collect enough premium to outpace your expected occasional losses.
So if you go too far out.
If you go too far out, you might win 99% of the time, but you collect literal pennies, and one single loss wipes out years of gains.
Right. Okay, so we have a high probability directional bet. But here's where it gets really interesting, because with a credit spread, we aren't just betting on direction. We are simultaneously betting on volatility. And this brings us to Vega.
Vega is often the hidden driver of profit that retail traders completely miss.
How so?
Well, credit spreads are inherently net short implied volatility. Because your short option is closer to the current stock price, it naturally carries a higher vega than your further out long option.
Meaning my overall position is sensitive to how much fear or uncertainty is in the market.
Precisely. Implied volatility is just the market's expectation of future turbulence. This means you actively want to execute these trades when market volatility is elevated.
Like when everyone is panicking.
Exactly. Think about the day right before a major earnings announcement or during a sudden geopolitical crisis. In those moments, option premiums are heavily inflated because everyone is buying insurance.
Right, so you want to step in and act as the insurance company when premiums are at their absolute highest.
Because you are positioning yourself to profit from what's called a volatility crush.
A volatility crush.
Yeah. The moment the earnings report drops or the crisis stabilizes, the uncertainty just vanishes. The expected volatility suddenly drops. When that happens, the extrinsic value of the entire spread collapses.
So the price of the options just deflates like a balloon.
Yes. You could be sitting on a substantial unrealized profit just days after opening the trade, even if the stock price itself hasn't moved a single inch, simply because the fear left the market and the premiums deflated.
That's incredible. You're literally getting paid because people stopped panicking.
It's a great feeling.
And the other massive wind at our back is theta, right? Theta represents time decay.
Yeah.
And time is, well, it's like a melting ice cube for options. Every single day that passes, the spread loses extrinsic value, which is perfect when you're the one who sold it.
Theta is the steady, relentless engine of a credit spread. The short option you sold decays more rapidly than the further out of the money long option you bought.
Oh, I see.
That differential steadily shrinks the overall value of the spread. And since you want to buy it back later for cheaper than you sold it, that decay is exactly what you want.
Wait, I have to push back here.
Yeah.
Because if time theta is always working in my favor, I mean, if every tick of the clock makes me money, why wouldn't I just hold the trade until the absolute last second of expiration day? Why not squeeze out every single penny of that premium I collected?
It is the most logical question to ask, and honestly, it is the exact behavioral trap that routinely destroys amateur traders.
Really?
Yes. The answer is our final Greek, gamma. Gamma is the rate of change of delta. And as expiration rapidly approaches, especially in the final week, the gamma of near-the-money options increases exponentially.
Whoa, okay. Exponentially increasing gamma sounds like a phrase a physics professor uses right before an explosion. Keep it simple for me. Why does the last week or the last day matter so much? What does that actually mean for my portfolio?
It means the math gets violent. In the final days of a trade, if the stock price even slightly challenges your short strike, the delta of your position will swing wildly.
So the probability jumps around.
Right. An option that had a low probability of being in the money can suddenly jump to a high probability with just a tiny fluctuation in the stock price.
Yeah.
That causes massive, terrifying swings in the real-time monetary value of your spread.
So holding a credit spread to the very last day fundamentally alters the strategy. You're telling me it transitions from a slow, mathematical, time-driven income trade into a highly leveraged, coin-flip binary bet governed almost entirely by gamma risk.
That is exactly what happens. You are risking massive unrealized gains just to squeeze out the last 10 cents of premium.
Wow. Turning a high-probability math equation into a slot machine just for a few extra dimes, that's a terrible trade-off.
It really is.
And since gamma makes that expiration week so dangerous, the research points out something fascinating. The specific asset you are trading dictates exactly how dangerous it can get. If the math is sound, the real world must have hidden traps, right? Which brings us to the actual market mechanics of settlement.
Yeah, settlement is where traders experience the most devastating surprises because not all options settle the same way. You have to understand the fundamental difference between physical settlement, which we see with standard equities, and ETFs like the SPY, and cash settlement, which is used for index options like the SPX.
Okay, let's start with the dangerous one. Physical settlement. SPY options, which track the S&P 500, are American style. I always thought an option just expired on a Friday, but American style means they can actually be exercised at any time, right?
Yeah.
And they settle in actual physical shares of the ETF.
They do, and this introduces nonlinear risks that completely bypass your beautifully defined risk parameters.
Give me an examples.
Well, for example, there's the dividend trap. If you have a short call spread on a dividend-paying stock or ETF and an ex-dividend date is approaching, the person who bought that option from you might choose to exercise it early just to steal the dividend payout.
Wait, if they exercise my short leg early, what happens to me?
You instantly get assigned a short stock position. And worse, you now have an explicit obligation to pay that dividend out of your own pocket to the lender of the shares.
Oh, wow. It turns a theoretical paper loss into cold, hard cash missing from your account.
Exactly.
But as bad as that is, the absolute nightmare scenario outlined in the research is something called pin risk. Walk me through this. What exactly happens to me if my physically settled SPY trade gets pinned right between my two strikes on a Friday afternoon at the closing bell?
Okay, let's paint the grim picture. It's Friday at 4 p.m. The closing bell rings. Your ETF closes exactly between your short strike and your long strike.
So right in the middle.
Yeah. Because it's American style and physically settled, your short leg expires in the money. But your protective long leg, your safety net that we paid for, expires completely worthless.
Right.
So over the weekend, the clearinghouse automatically assigns you on that short leg.
So on Saturday morning, I check my brokerage app. What do I see?
You see that you are now holding a massive, totally unhedged physical stock position. Your protective put is gone. It expired. You are just holding raw shares.
And if some massive macroeconomic news breaks over the weekend, maybe a central bank unexpectedly hikes rates or there's a geopolitical conflict, and the market gaps down violently at Monday's open.
You are fully exposed to the theoretical infinite downside of holding those shares. That gap down happens before you can even hit the sell button on Monday morning.
Yeah.
It completely obliterates the defined risk architecture we just spent all this time building.
That is absolutely terrifying. You go into the weekend thinking your risk is capped at $200, and you wake up on Monday morning on the hook for tens of thousands of dollars of stock depreciation. So what is the institutional solution to this? They can't possibly just accept that risk.
Oh, they don't. The solution is trading cash-settled European-style index options. For the major funds, that's the SPX. For retail traders, it's the XSP, which is the mini SPX that is scaled down to a tenth of the size.
Because they are European style, they can only be exercised at expiration. So no early exercise means no dividend traps.
Correct. And far more importantly, because they are cash settled, no physical shares ever change hands.
Wait, really? None at all?
None. If your XSP trade gets pinned between the strikes at expiration on Friday, there is no weekend assignment of shares. The clearinghouse simply calculates the exact mathematical monetary difference between the closing price and your strike. They debit that cash from your account, and the position just vanishes.
Poof, into the ether.
Exactly. You hold zero residual market exposure moving into the next trading session. There is no weekend gap risk whatsoever. These PM-settled XSP options establish their final cash value precisely at 4:00 p.m. Eastern, giving you total clarity and safety.
Okay, so knowing how to survive the trade by dodging pin risk is half the battle. But to truly trade like a quantitative fund, we need to look under the hood at the regulatory plumbing and the tax codes that give institutions their real edge. How do they actually manage these trades day to day?
This is where rigorous backtesting and systematic management completely replace emotion. The research analyzed massive data sets from algorithmic platforms, simulating millions of credit spread trades, to find the optimal management rules.
And the data totally destroys the idea of set it and forget it, doesn't it?
Completely. The highest risk-adjusted returns were achieved not by holding to expiration, but by systematically taking profits at 50% of the maximum credit and employing a strict 50% stop loss.
Let me put real numbers to that. If I collect $100 in premium up front, I have a resting order to close the trade the moment I'm up $50. But I also cut my losses and exit the moment I'm down $50.
Yes, and the Sharpe ratio on that is incredible, 0.83. By doing this, you drastically reduce your time in the market, which inherently lowers your exposure to black swan events.
Makes sense.
You completely eliminate that terrifying gamma tail risk we discussed because you are never holding into the final days, and mathematically it deeply smooths out your equity curve.
But the regulators are watching how aggressive these strategies are getting, especially with zero data expiration options. I was reading about some major 2026 amendments to FINRA Rule 4210, and I couldn't believe it.
Oh, it's a massive paradigm shift for active traders. Historically, if you day traded, you were flagged as a pattern day trader and forced to hold $25,000 in your account to participate.
Right, the old PDT rule,
That old rule is fundamentally gone.
replaced by something much stricter.
Yes. FINRA has implemented a modernized real-time intraday margin standard. Brokers must now actively monitor accounts for intraday margin deficits minute by minute.
Wow, minute by minute.
Yeah. If you are a trader aggressively managing 0 days to expiration credit spreads, you can't over-leverage your account and hide between overnight settlement periods anymore. The broker's algorithms will either block the trade in real time or hit you with an immediate margin call before the closing bell.
Which brings up a fascinating point about the margin algorithms themselves. The CBOE exchange requires algorithms to group different option legs together to figure out your total margin requirement. It's called combinatorial optimization.
It sounds incredibly dense, but it's crucial for capital efficiency. If a fund has hundreds of overlapping option legs, the clearinghouse relies on the broker's algorithm to pair them up into recognized risk-defined strategies like credit spreads to calculate how much margin they need to hold.
I was trying to visualize this, and it feels like packing the trunk of a car for a long road trip.
I love this analogy.
So older, greedy algorithms are like clumsily throwing the first bag you see into the trunk. Sure, it gets in there, and you technically meet the requirement to pack the car, but you waste a ton of space. But the advanced linear programming solvers the institutions use, they map out the entire complex geometry of your portfolio. They pack the trunk perfectly, recognizing every single multi-leg hedge to absolute millimeter precision.
That is a brilliant way to visualize it. And the real-world impact of packing that trunk efficiently is staggering. According to the institutional stress tests in the research, optimizing that combinatorial math saves large funds up to $500 million in required margin.
$500 million.
Exactly. That frees up $500 million to deploy elsewhere.
That capital efficiency is why institutions dominate. But they amplify that edge even further through the tax code. We have to talk about IRS Section 1256.
The magic 60/40 rule. If you trade options on a standard ETF like SPY, your profits are typically taxed as short-term capital gains at your highest ordinary income tax rate. It's a massive drag on compounding your wealth.
Nobody likes that.
Right. But if you trade broad-based, cash-settled index options like SPX or XSP, they are statutorily classified as Section 1256 contracts.
And what does that classification actually do for my tax bill?
It means that regardless of how long you hold the trade, even if you open and closed it in 5 minutes, 60% of your gain is automatically taxed at the highly favorable long-term capital gains rate. Only 40% is taxed short-term.
That is wild. Just by changing the ticker symbol from SPY to SPX, you get a massive structural tax break.
Oh, it gets even better when you consider accounting. Have you ever dealt with the wash sale rule?
Oh, yeah. That's when you take a loss on a stock, but you buy it back within 30 days, and the IRS says, nope, you can't deduct that loss yet. It's an absolute accounting nightmare.
Well, Section 1256 contracts utilize mark-to-market accounting at year-end. This means the IRS treats your entire portfolio as if you sold everything at the closing price on the very last day of the year.
So they just draw a line in the sand.
Yes, the slate is mathematically wiped clean. Because of this, individual trades throughout the year aren't tracked for wash sales. They are entirely exempt. An aggressive quant can rapidly close and re-enter SPX credit spreads dynamically all year long without ever triggering those restrictive tax accounting penalties.
That is an insane advantage. So let's look at the big picture of what we've covered today. We started with this scary concept of options being unlimited risk gambling, but we learned how to architect a vertical spread to strictly cap our downside using reinsurance.
Right.
We found the mathematical sweet spot of probability using delta. We learned to use time and volatility to our advantage. We dodged the nightmare weekend pin risk by using cash-settled index options. And we optimized our management rules and our taxes.
We truly moved from the idea of gambling to engineered structural finance.
We really did. But before we go, I want to leave the listener with one final mind-bending thought that builds on everything we just discussed. So we know how to cap risk. But is there a way to eliminate market risk entirely? The research points to something called the box spread. How does this work?
Ah, the box spread. This is where options transcend standard trading and become a literal corporate finance loophole. Imagine combining a bull call spread and a bear put spread at the exact same strike prices.
Wait, if I have a bullish spread and a bearish spread simultaneously, doesn't one just win and the other lose? Don't they just zero each other out?
By locking those two together, you perfectly offset all directional market risk. It doesn't matter if the stock goes to the moon or goes completely bankrupt. The settlement value at expiration is 100% guaranteed and mathematically predetermined.
So why do it if the payout is just flat?
Because since the payout is guaranteed, institutions use what's called a short box to synthesize a fixed-term loan. They aren't betting on stocks at all. They sell the box spread today to collect a massive influx of cash up front, and they legally commit to repaying a fixed, slightly larger amount at expiration.
Oh my God. They are basically securing cash loans straight through the options clearinghouse.
Exactly.
They completely bypass traditional banks, often at interest rates far cheaper than their own brokers' margin rates. That is unbelievable.
It is the exact same caps risk math of the credit spread, just applied non-directionally to manipulate the time value of money itself.
So the next time someone tells you that options trading is just reckless gambling, remember the box spread. Remember that the smartest players in the room aren't pulling slot machine levers. They are engineering synthetic loans, legally manipulating the tax code, and capping their risks down to the absolute penny.
Well said.
The whole different game. Thanks for joining us for this deep dive, and we'll see you next time.